I'm Josh Bowser. I'm from Central Michigan University. I would say it's real world experience, being hands-on, kind of stepping outside the classroom, getting different perspectives. It's been exciting. It's been fun to learn, really. I'd say it was probably right on par. It was we expected it to be challenging, but we knew that going into it, so the expectation was right there. It's made me think about it. I really thought did want to be a financial analyst, and I continue to still want to do that. I like to gain more experience. As I can see, there's a lot of varying factors that have gone into the report, and there's other techniques that we may not have the knowledge yet to we haven't learned in class, and those other extra things we can apply to the report would be great. Yes, absolutely. It was, in terms of having judges sitting here in front of you and really kind of grill you on some questions, it was, you get a real perspective of what to expect when you step outside of school.
First of all, we would like to thank all the judges for being here and letting us present our final report on Herman Miller. We're Central Michigan University. I'm Jingyan Ni.
I'm Josh Bowser.
I'm Justin Nye.
I'm Wesley Long.
And I'm Blake Anderson. Our agenda today covers the business overview, financial performance, our valuation, and the risk analysis. The methods of analysis that we use to evaluate Herman Miller include the discounted cash flow model and the method of comparables. Upon conclusion of our analysis, we predict Herman Miller to be valued at $23.07 per share 1 year ahead. This is a 10.01% increase from its current price of $20.97 per share, and therefore leads us to present Herman Miller with a buy recommendation. Herman Miller is a leader in the contract furniture industry due to their high-performance production system, their drive for innovation, and their consistent need for expansion, such as their recent acquisitions of Brandon Nemshoff and Posh. The contract furniture industry is a 9 to 12 month laggard of the United States economy. Some of the leading factors of performance for this industry include corporate profits, service sector employment levels, non-residential construction activity, office vacancy rates, and architectural billing activity. The figure at the bottom of the slide shows the market share for this industry. As you can see, H&I and Steelcase are some of Herman Miller's top competitors. Herman Miller is extremely competitive within their industry. The brand is not only recognized within their dealer networks, but on a global basis. The design concepts they use come from independently contracted designers, which they have used since the 1950s. Their price point is set a bit higher than the competitors, as their higher quality products are reflected by the market. The speed of Herman Miller provides the company with a 10 to 20 day lead time and ensures timely deliverables. Herman Miller currently owns 60% of the sales in the dealer network in which they operate and envisions themselves tapping the remaining 40%. I would like to introduce Wesley now with the company financials.
Thank you, Blake. As previously mentioned, one of Herman Miller's main competitive advantages is their ability to maintain inventory turnover well above their main competitors. This graph is showing the inventory turnover as compared to their competitors. Sorry if it's unfortunately a little hard to see, the colors didn't work too well. Historically, they've done this through the use of the Herman Miller performance system, but they have more recently taken steps to increase production and reduce expenditures. In fiscal year 2009, they spent $28.4 million in restructuring costs. This was followed by further restructuring in fiscal years 2010 and 2011 of $16.7 million and $3 million respectively. Herman Miller management has cited these expenditures as the main reason for operating losses of $25.3 million in fiscal year 2009 and $17.7 million in fiscal year 2010. The cost restructuring was done primarily through the consolidation of Brandrud and Nemshoff manufacturing facilities, as well as the consolidation of Integrated Metal Technologies and Herman Miller manufacturing operations. This graph is depicting Herman Miller sales. As you can see, from the years 1983 to 2001, they experienced fairly solid growth, growing from $300 million to $2.2 billion in annual sales. After this period, they experienced a slight reduction in sales, and from the periods 2002 to 2011, their sales fluctuated with the economy. In 2008, they regained sales of $2 billion, up from just $1.3 billion in fiscal year 2003. Sales again fell to $1.3 billion in 2010. However, Herman Miller has since began to rebound, realizing sales growth of 25% in fiscal year 2011. Next, Justin will talk about our discounted cash flow analysis.
Thank you, Wes. Using the discounted cash flow model, we valued Herman Miller's stock price in 1 year to be $23.07. Cash flows for the industry are very dependent upon sales. Cyclicality in the industry led to a large downturn in sales in 2008 and 2009. As economic conditions continue to improve, so will Herman Miller's sales. Over the next 5 years, Herman Miller will recapture sales equal to their 2001 level, which was over $2.2 billion. This will require an annual increase of 12.69%. As you can see on the chart, once they reach their 2001 level in sales, we no longer expect Herman Miller to maintain atypical growth. Through our cash flows, we believe that Herman Miller will also see an increase in their cash flows. Over the historically, there have been wider margins and higher cash flows when sales are increasing. As you can see on the chart, over the past 20 years, operating cash flows on average have been 8.78% of sales, while free cash flows on average have been 5.58% of sales. Therefore, we were able to forecast free cash flows to estimate our target price of $23.07. We performed a sensitivity analysis on two important inputs: weighted average cost of capital and year one growth rate. We chose these two inputs because we believe they are most likely to change over the investment horizon. As a result of Herman Miller's debt restructuring, their corporate bond rating and cost of debt could change, and therefore their WACC would be affected. As we previously mentioned, cash flows are highly impacted upon sales and economic conditions. While we do expect Herman Miller to maintain high sales growth, change in economic state could lead to a slight variation in our growth rate. As you can see, we had different ranges for our growth rate and our WACC to get our possibilities. As you can see, there are a lot of lime green and yellow, which represent buy and hold recommendations. There's not as much red, which are sell recommendations. And now I'm going to hand it off to Josh, who's going to talk about our method of comparables.
Thank you, Justin. In our method of comparables, we've chosen 4 different industry competitors, which we believe are the closest peer group to Herman Miller: Knoll, H&I, Steelcase, and Compact. We've calculated the method of comparables through a current fundamental value, which consists of a trailing PE. We've done this by taking an earnings per share basis and applying it to their current fundamental value, which is $20.71 per share. We then, in an effort to move the method of comparables ahead by 1 year, taken the previous multiple from the trailing PE, and we've calculated a forecasted EBIT of $152.6 million. This gives us a $42.74 per share estimated fundamental value for 1 year ahead. So the $42.74 per share, we really believe is just completely overvalues Herman Miller. So we decided that in our target price, we're not going to include our method of comparables, and the DCF provides a much better analysis. Next is Jun Young, who will present a risk analysis.
Thank you, Josh. Now we'd like to address some of the investment risks. First, financial risk. Due to the cyclical nature of Herman Miller's business, adverse economic and industry conditions would have a negative impact on the company. Second, market risk. The markets that Herman Miller operates in are highly competitive. Increased market pricing pressure would make it difficult for the company to attract new businesses. In recent years, international imports have added to the deterioration of domestic sales in the office furniture manufacturing industry. Third, strategic risk. Herman Miller plans to grow through expansion into the healthcare industry and the international market. It might not be able to reach its goals if products and services fail to meet the demands of these markets. Herman Miller differentiates itself through constant innovation. In order to keep this advantage, Herman Miller has to sustain its talent pools and also investments on the risk and on the research and development. Fourth, operational risk. Herman Miller's production relies on various raw and component materials. The existing dealer network is also crucial to its business. Disruptions in the supply chain would adversely affect its operation. Volatility in the commodity market could also hurt its profitability. Last but not least, Herman Miller's business presence outside the United States exposes the firm to certain international risks, including unfavorable foreign policies and exchange rates. Next, Josh is going to conclude our presentation.
Thank you, Junyo. To conclude, our target price is $23.07 per share. This incorporates the discounted cash flow model and excludes our method of comparables. To reiterate, we believe the method of comparables overvalues Herman Miller. And we conclude with a buy recommendation. We'd now like to direct our attention to the judges for any questions.
You mentioned one of the risks, disruption in supply chain. Where are they getting their raw materials and parts from?
They acquire their raw materials mostly from domestic sources, but they also have, but some of the since they don't. They not only have raw materials, but also component materials, which is already manufactured. They just assemble it. Some of those are actually manufactured abroad, and without the shipping could also affect the prices.
Okay, so the majority of it is domestic, but there is some that has to be shipped.
Yeah.
We've got a 12.69% assumed growth rate. That's occurring within an economy here that's growing 2%. So obviously, I've got to get growth from somewhere else. It's got to come from Posh or potentially something in Latin America, South America. What part is their success in these emerging markets? Given the fact Europe's going to be a problem out there for them. How much of the success in this $23 price target is basically driven on their success with this international push that they want to have?
I would say it's partial. More so the 12.69% is a sales growth along with the economy. Like you said, it is 2% relative to now. But as far as the stock market, recently it's been on an upswing. There's been investor confidence. As we can see, the employment rates previously have dropped, which is an indicator that, in the past, 6, 8, 12 months, that the economy has started to upswing. We attribute part of the growth to Posh. I would say it's not very significant in terms of that 12.69% in the next, 5, 10 years. From there on, I think it really will impact their sales. Next question.
Follow up to that, they do have continued acquisitions. Will they be funding it internally? Will there be a risk of raising capital that may dilute equity shareholders if they have room to raise debt?
To be honest, we have to go back and research it, and we can definitely get back to you. More than welcome to send you an email.
What are the biggest risks to their being able to achieve the growth rate that you're assuming? If they took restructuring charges in the last 3 years, I would assume that from their balance sheet is in better shape to be able to produce, to be able to produce earnings that are more sustainable. Well, what is the big risk that they have in terms of execution right now? Is it international? Is it their existing customer base? How diversified are they? Can you comment on that?
Well, we look at how risky they are based on how they plans to strategize their going forward. And we think now their biggest risk is probably their healthcare industry, because we think international risk is part of it, but right now it still consists of a really small part of their products, and so we think the domestic, and in order to keep their dealer network is also very important, because they want to also increase their market share within their dealer network. So we thought domestically to be able to sustain their position is probably the biggest risk.
I just want to add to that. We also feel like just the biggest risk for us is the economy. As you saw on the sales chart, they're very cyclical with how the economy goes. After the recession in the early 2000s and in 2008, you saw sales really decrease. And so if economic conditions don't improve like we think they will, you could see a drop in sales. So that would probably be the biggest risk that we see. It's just the global economy.
How much are you concerned with they've got 14% of their business being tied to the government, and with the slowdown that we're seeing on both the federal level and the state and local level, a pretty good sized customer who's probably not going to be buying as many chairs and desks and wall pads. What concern do you have for that, for growth targets we've got here with a slowing condition in government purchases on this?
As Blake mentioned in the presentation, they're trying to penetrate the other 40% of their dealer networks, and I believe move away from the contract furniture industry and government contract providing furniture for the government. So if they can continue to increase their share in their dealer networks, then that'll provide the revenue loss from decrease of government contracts.
Thank you.
Thank you.